In 1947, Britain was drowning in debt from World War II. Their central bank did the only thing it could: print money and buy government bonds. The end game. The consensus was simple: markets are about to collapse. Instead, UK stocks ripped higher, not after the crisis, during it. That's the part most people still don't understand, because the US is walking into the same setup today. Traditional foreign buyers are fading, and the US has to refinance around $10 trillion in debt in the next 12 months. So the Federal Reserve stepped in and started buying US Treasuries again. Most people look at that and see a collapse coming. They're looking in the wrong direction. The real question isn't, will it crash? It's, are you holding what capital runs to when currency bleeds? Let's start with what's actually happening, because most people miss the point entirely. The US government carries over $38 trillion in debt. But here's what matters right now, not the total. The timing. Roughly $10 trillion of that debt matures in the next 12 months alone. That's $830 billion every single month that comes due and needs to be refinanced, most of it at rates much higher than when it was issued. And over 50% of all US government debt matures by 2028. This isn't a slow burn, it's a refinancing wall that we're hitting now. The government isn't writing a check for any of that. They refinance, issue new debt to pay off old debt. Routine, except for one thing. The buyer's side of that trade is breaking down. Quietly. For 70 years, foreign central banks were the most reliable customers the US Treasury had. Japan, China, the UK. These institutions parked their reserves in treasuries because it was the safest, most liquid asset on earth. That stopped. Central bank holdings have been stagnant for years and are now declining. One of the world's most reliable buyers of American debt has gone on strike. There's a second category: foreign private investors, wealth funds, pension plans. They've continued buying. That sounds reassuring until you look at what they're buying relative to how much new supply is being created. Between the 1980s and roughly 2016, foreign holders were accumulating US Treasuries faster than the government was issuing them. Since 2016, that reversed. As a percentage of total outstanding US debt, their share has been falling every year. They're buying, just not nearly enough to keep up with how fast the US government is issuing. So on both sides of the ledger, official and private, foreign demand is losing ground to supply at exactly the moment supply is about to surge. This imbalance shows up in something most people have never heard of: the term premium. Think of it as the risk surcharge investors charge for holding long-term versus short-term debt. When demand is strong and buyers are reliable, that surcharge stays low, which keeps borrowing costs down across the entire economy. When demand weakens or risk increases, investors demand more yield. The surcharge rises. The term premium has risen almost 2% from just a few years ago to today. That's the market saying, lending to the US government carries more risk than it used to. We want more in exchange. The term premium is still below its 60-year historical average of 2%, but if it were to revert there, long-term yields go from just over 4% to around 5.5%. That's not a worst-case scenario. That's what the math looks like if supply stays high and buyers keep disappearing. A move from 4 to 5.5% doesn't just hurt Washington. It hits mortgages, it hits business loans, it hits assets, it hits you. The government only has two paths from here: cut spending or override the market. Cutting is essentially off the table. 2/3 of federal spending is mandatory: Social Security, Medicare, entitlements that can't be switched off. Add in defense and interest on the debt, and it totals around 80% of the 2026 federal budget. Rising geopolitical tensions make cutting defense politically impossible, and we can't stop paying interest. Meaningful spending reduction isn't coming. So the second lever. The Fed steps in, prints money, and buys treasuries directly. This artificially reduces yields. It replaces the demand that foreign buyers withdrew. It caps borrowing costs regardless of what the market thinks the risk is worth. This is already happening. The Federal Reserve recently began what they're calling reserve management purchases, buying US Treasury bonds at $40 billion per month. And according to the Fed's own projections, they expect their balance sheet to keep expanding until at least 2033. 8 years. Not to fight an emergency, to fill a structural hole in demand for US government debt. Quick note, we get a new Fed chair in May, and he may have other ideas, albeit with a similar result. Watch one of my other videos, the new Fed chair's plan to reduce the debt, to learn more. Now back to Britain in 1947. Because this is where most people's mental model breaks, and where the actual insight is. The Bank of England pegged long-term rates at 3%. It printed money and bought bonds to keep it there for years. The British pound lost almost half its value. British savers holding cash or government bonds watched their purchasing power get cut nearly in half, not through a dramatic crash, through slow, quiet erosion. The number in their account didn't change. What it could buy did. And British stocks rallied hard. This is the mechanism almost nobody explains. When a central bank prints to cover its government's debt, it doesn't solve the problem, it changes it. Instead of a debt collapse, you get a currency bleed. Slower, quieter, more politically survivable. Capital doesn't disappear. It relocates. It moves out of the currency and into things the currency can't erode. Stocks, hard assets, anything with intrinsic value that can reprice upward as the currency weakens. Quick pause. Speaking of stocks, Seeking Alpha's picks have crushed the S&P's return since 2022. There's a link for 10% off in the description. Now back to the mechanism. The British stock market surged not because the economy was thriving, it surged because capital had nowhere else to go. Here's the problem with the playbook most investors are holding. It was written for 2008, the deflationary crash, where cash and treasuries are the safe destination. Move to safety, wait for the panic to pass, buy back in at the bottom. That playbook works when the crisis is about asset prices collapsing while the currency stays intact. It fails completely when the currency itself is what's being debased. These are two different crises with opposite solutions. In a deflationary crash, cash appreciates relative to everything else. Holding it is protection. In a currency debasement, cash loses purchasing power while real assets appreciate. Holding it is the exposure. The same move that saves you in one scenario destroys you in the other. Most investors have only ever prepared for one of them. Sitting in cash or long-term bonds while the Fed prints $40 billion a month to cover a structural demand shortfall isn't safety. It's exactly what British savers did in 1947. They thought they were being responsible. The slow math of what happened to their purchasing power over the following decade was devastating, even though their bank balance never showed a crash. The investors who came out ahead weren't the ones who moved to safety. They were the ones who understood where capital flows when governments start printing money to cover their own debts. They owned things that could rise in price as the currency weakened. The lever has already been pulled. The British episode didn't look dangerous until it was well underway. This one is already underway. The only question left is whether you're positioned for it or exposed to it. If this changed how you see what's happening, share it with someone whose savings are parked in cash, waiting for the storm to pass. They may be sitting in exactly the wrong place. If you like this video, hit subscribe. We publish fresh content several times a week to help you protect and grow your wealth. And none of this is personal financial advice. This is education so you can build your own plan. Next, watch something that is relevant to what is coming. How the rich make money with inflation. It's on the screen. In the description, you'll find links for 10% off Alpha Picks. You'll also see a link to my Wealth Builders Blueprint, a list of resources that can help you grow your wealth. I also included a link to Zacks Confidential, a stock recommendation service with dual money-back guarantees. Check them out. Thanks for watching. See you on the next one.